What's up everybody, Jaspreet Singh here from my phone again because the Federal Reserve Bank just raised interest rates by 0.5%, which is the biggest interest rate hike in over 2 decades. And as soon as they did that, the stock market rallied by almost 1,000 points. So I want to go over what's going on. The Federal Reserve Bank Chairman Jerome Powell said that the reason why he raised interest rates so aggressively was because, quote, I took notes on this, inflation is much too high and we understand the hardship that this high inflation is causing. So they are working expeditiously to bring this high inflation back down. Now, as soon as he said this, interestingly, the stock market rallied by almost 1,000 points. And you'd expect that if you're going to raise interest rates so aggressively, that the stock market would fall. Because raising interest rates makes borrowing money more expensive and makes it more expensive to do business, which should hurt companies and stocks. So why did the stock market go up? Well, there's 4 things that I want to go over. First, what the Fed said and what to expect with the Fed. Second, I want to go over what this means for the economy. Third, I want to go over what this means for the stock market particularly. And fourth, I want to go over what this means for inflation. So let me start by talking about what the Fed said exactly. So the Fed said that they're going to raise interest rates by 0.5%. And they also said that they do not plan to raise interest rates more aggressively. So they said that you can continue to expect more 50% basis point increases throughout the year, but don't expect 75 basis point increases. What that means is that they will most likely raise interest rates by 0.5% multiple times throughout 2022, but they don't expect to raise interest rates by 0.75%. So 50 basis points, 0.5% is the biggest interest rate hike that we've seen since the dot-com bubble bursting back in the 2000s, the early 2000s, so 2000, 2001. So they're saying that that's how they expect to continue to increase interest rates. The second thing that they said was related to their balance sheet, that they want to start selling off and letting go some of their assets. Now, originally we thought that in May, right now in 2022, that they would start selling off around $90 billion worth of assets a month. And what they said was, no, they're going to start by selling off around $47.5 billion worth of assets a month, and they're going to work up to selling off $95 billion worth of assets a month. Essentially what that means is during the year 2020 and 2021, the Federal Reserve Bank bought up a bunch of assets that nobody else was buying. These were things like treasury bonds, these were things like mortgage-backed securities. So the Fed printed a whole bunch of money, caused inflation to then go out and buy these assets. Now the Fed has this huge balance sheet of trillions, about $9 trillion worth of assets. And this is contributing to inflation because when you print more money, it causes inflation. Right? The Fed doesn't have a stockpile of cash anywhere, and so they had to print this money in order to buy these assets. Well, now, to help combat inflation, the Fed wants to finally start selling off some of these assets. But they're not doing it as aggressively as many investors thought as they were going to do it, because when the Fed was buying these assets, they were buying these assets at around $120 billion a month. So the Fed was printing $120 billion a month to buy up the assets, and now they're going to start selling them off at a rate of about $47.5 billion, and they'll work their way up to about $95 billion worth of assets selling a month. And the last thing that the Fed said is, yes, don't expect a 0.75% interest rate hike. Expect multiple more 0.5% interest rate hikes. So that's what the Fed said. This brings me to number 2, the economy. And I have another quote for you here because Jerome Powell said, quote, the American economy is very strong and well positioned to handle tighter monetary policy. So the reason why the Fed is able to raise interest rates, according to Jerome Powell, is because the economy is very strong. So the kind of hints at saying if the economy wasn't so strong, if we entered a recession, then maybe the Fed won't continue to raise interest rates. Maybe the Fed will start cutting interest rates again. That's what it's kind of saying. He didn't directly say that, but that's kind of what it's implying, because he's saying that the only reason why we're willing to raise interest rates right now is because of the strong economy. Now, that's kind of an interesting statement to make, especially now, because many people from Fannie Mae to big banks are saying that they expect a recession to come in either later 2022 or 2023. And then you also have the fact that now it is going to become more expensive to borrow money. because now the interest rates have gone up by another 0.5%. That means it's going to become more expensive to get a mortgage. You can expect mortgage rates and refinance rates to go up. Credit card debt is going to become more expensive because that's not fixed rate debt, that's variable interest rate debt. And then you can expect car loans to become more expensive. And for the government side, you can expect the national debt that we have to become more expensive as well, because this $30 trillion worth of national debt that the United States government has, it's not fixed rate debt. It's variable interest rate debt, meaning every few years it readjusts. A big portion of our debt is only a 3 to 5 year term, which means every 3 to 5 years, the interest rate's gonna readjust. And so as interest rates go up, the payments that the United States government has to make are gonna go up as well. So if the government's payments go up, that means they're gonna need more tax dollars to pay off all this national debt. So the economy is going to go through this weird phase because one, we're already seeing a slowdown in our economy. The GDP report for the first quarter, January, February, March, showed that our economy didn't grow. It actually decreased, which was not what everybody expected. The government, economists, the Fed all expected our economy to grow by around 1.4% in the first quarter of 2022, but we actually declined by 1%. So our economy is already slowing down, and now with interest rates rising, you can expect it to become more expensive to buy a home, more expensive to buy a car. So you can expect this to slow down spending, not just for consumers, but also businesses, because that also means it's more expensive for businesses to borrow money now because, well, interest rates are up. This brings me to the second thing, or third thing that I want to talk about, which is the stock market. The stock market went up when the Fed said that they were going to raise interest rates, when everybody would expect that the stock market would go down. And the reason why the stock market went up was because, well, the Fed made it seem like inflation isn't that big of a deal. Now, I know they said that inflation is a problem, which is why they're raising interest rates, but many investors are pricing in the fact that, one, inflation is really bad, and to fight this high inflation, the Fed is going to get even more aggressive with what they're doing. That means the Fed would raise interest rates by 0.75%, and we might see multiple 0.75% interest rate hikes. So not only did the Fed not raise interest rates as fast as some people were warning about, but the Fed also said, don't worry about it. We're not going to raise interest rates as aggressively. So the Fed kind of made it seem that this interest rate hike isn't going to be as aggressive as many people expected, because the Fed doesn't want to hurt the economy. Remember what I said just a minute ago. The only reason why the Fed is willing to raise interest rates now is because the economy is strong. So the Fed said that they want to have this kind of soft landing. That was the wording that he kept saying, that they want a soft landing where they're going to raise interest rates slowly and hope that the economy won't get hurt very bad, because they don't want to push the economy into a recession. So when investors heard that, they got very excited, because if the Fed is not going to raise interest rates super aggressively, that means we will continue to see this kind of loose monetary policy. We're not going to see a sudden shift in the economy, and hopefully that means that we won't see a recession. But that doesn't solve the inflation problem. But that's why investors are more worried about inflation than recession, or they're more worried about recession than inflation, just depends. But this is why investors are paying attention to this, because if the Fed is more worried about a recession than inflation, that means that that's good for the stock market. But if the Fed is more worried about inflation than a recession, well, that's not good news for the stock market. So this is what investors are paying attention to. And it looks like right now, the Fed is more worried about a recession than fighting inflation, which is why investors then poured money into the stock market and the stock market rallied. And this brings me to number 4, which is understanding what this means for inflation. And I have another quote for you. So I'm going to get to the inflation side in just a second, but he said, Jerome Powell, in addition to everything else going on, he said that COVID-related lockdowns in China are likely to exacerbate the supply chain disruptions. The Fed committee, is highly attentive to inflation risks. So what he's saying is, yes, inflation is a problem, and it might get worse because of all the supply chain issues in China. Now, before I dive deeper into this, I do want to let you know that if you want to stay up to date on what's happening in the top finance and business news, like right when it's happening, you can check out Market Briefs. It's a free finance and business newsletter that I created, where our team breaks down exactly what's happening in the business world into a fun and easy to read and witty newsletter. It's just 5 minutes long, if that, every morning. I promise you're gonna love reading it every morning. So if you want to join Market Briefs, it's completely free, and I'll put the link for you down in the description below. So what he's saying about inflation is, yes, inflation's a problem. They want to start fighting inflation, but there's also other issues, supply chain issues. So it's almost like they're starting to point fingers a little bit, where they're saying, yes, inflation's a problem. We don't want to get too aggressive to fight inflation because, well, the economy and a potential recession. But the reason why inflation might get worse is because China and supply chain issues over there. So kind of an interesting response, because originally when the Fed started loosening their monetary policy, when they started cutting interest rates, they were buying up assets at $120 billion a month. Now we're going to start selling off assets at $47.5 billion a month and slowly work our way up. Then investors were predicting a 0.75% interest rate hike. Jerome Powell and the Fed said, no, we don't want to get that aggressive. We don't want to hurt the economy. We don't want to hurt the stock market. So we're only going to raise it by 0.5%. And don't worry about 0.75% interest rate hikes, at least for now. And then on top of that, you have some older Fed officials who have now left the Fed saying that if we really want to save the dollar, we don't want to continue to see this inflation problem, we need to crash the stock market. Now, they said that we need to bring the stock market down. They didn't use the word crash. But the reason why they say that is because we need to now make it more expensive to do business. We need to tighten our monetary supply so much that now we can actually reduce the amount of dollars in circulation. Essentially, we need to start burning dollars, because right now the value of the dollar is dropping. That's what inflation is. When you print more money, the value of each individual dollar goes down, causing the price of things to go up. So there's kind of a weird conundrum that the Fed is facing, because on one hand, they want to fight inflation, and on the second hand, they don't want to cause a recession. Well, if they got aggressive about fighting inflation, they would cause a recession. But they don't want to get aggressive about fighting inflation because they're worried about inflation, because they're worried about a recession. So if they're not willing to get aggressive to fight inflation, and we still see a recession, that means now we have an inflation problem and a recession problem. So the Fed is trying to teeter-totter right in the center right now, and they're hoping that by kind of doing this middle ground, inflation won't get too bad. Hopefully inflation will get better and they won't see a recession. That's the best case scenario. But if it doesn't work, that means inflation will continue to be very bad and we get pushed into a recession because our economy is already slowing down. So this is the kind of the tight wire that the Fed is walking down right now, where what do? Do you fight inflation? Do you fight a potential recession? And right now, they're trying to do both at the same time by not trying to over tighten the monetary policy to not trigger a recession, while also trying to not cause a major inflation problem. So this is the situation that we're in right now. Hopefully that provides some clarity as to what's going on with what the Fed said and what's going on with the stock market, what you can expect in the economy, and what is going on with inflation. If you enjoyed this video and you want to see how the inflation crisis that we're facing right now was created and what needs to be done to solve the problem, I made a video covering that, and you can watch it by clicking this button right over here. Thank you for watching, and as always, keep hustling. So the Fed said that they want to raise interest rates by 50 basis points in May, and that is twice the size of the previous